Investing 101. Start without feeling overwhelmed. Have you ever felt like you are standing on the edge of a cliff when thinking about investing? Well, you're not alone. According to a recent survey, over 60% of young adults feel overwhelmed by the mere thought of investing. But what if I told you that investing doesn't have to be as daunting as it seems? Hi, I'm your host at the Mental Wealth channel, and today we're going to simplify investing in our video. Investing 101. Start without feeling overwhelmed. Let's dive into why investing is a crucial step towards securing your financial freedom and how you can start without the stress. Why do people hold back from investing? First, let's talk about why so many people hold back from investing. One of the main reasons is the lack of knowledge. People often think you need to be a Wall Street expert to invest, but that's far from the truth. Another barrier is the fear of losing money. It's normal to feel this way, but understanding the basics can lower that risk significantly. Think about it this way. When you first learned to ride a bike, it probably seemed intimidating. But with a little guidance and practice, you got the hang of it. Investing is similar. The more you learn and practice, the more confident you'll become. Understanding the basics of investing. So, what are the basics of investing? Investing is essentially putting your money into assets like stocks, bonds, or mutual funds with the expectation of achieving higher returns over time. Let's break these down a bit. Stocks represent a share of ownership in a company. When you buy a stock, you become a part owner of that company. This means you can benefit if the company does well, but it also means you share the risks if the company faces challenges. Stocks are known for their potential to provide high returns, but they can also be volatile. Bonds are like loans you give to corporations or the government, for which they pay you back with interest. Bonds are generally considered safer than stocks, but they usually offer lower returns. Think of bonds as a more predictable, but less exciting, way to grow your money. Mutual funds are pools of money collected from many investors to invest in a diversified portfolio of stocks and bonds. By investing in mutual funds, you're essentially spreading your money across many different investments, which can reduce your risk. Mutual funds can be a great way to get started if you want a hands-off approach to investing. The superpower of compound interest. Now, let's talk about the superhero of investing: compound interest. Compound interest is when your interest earns interest. Sounds simple, right? But it's incredibly powerful. Imagine you invest $1,000 and it grows by 8% annually. In the first year, you earn $80. In the second year, you earn interest on $1,080, not just your initial $1,000, making your money grow faster over time. This is why starting early can make such a big difference. To illustrate, let's compare two scenarios. Scenario 1, you start investing $100 a month at age 25. By the time you're 65, assuming an average annual return of 8%, you'll have around $367,000. Scenario 2, you start investing $100 a month at age 35. By the time you're 65, with the same returns, you'll have around $162,000. That's more than double the amount just by starting 10 years earlier. How to get started with investing. But how do you get started? First, determine your financial goals. Are you saving for a new car, a house, or maybe early retirement? Your goals will guide where and how you should invest. For example, if you're saving for a short-term goal like a vacation next year, you might choose a safer investment like a bond or a high-yield savings account. But if you're investing for retirement, which could be 20 or 30 years away, you can afford to take more risks with stocks or mutual funds. Next, start small. Thanks to technology, you can now start investing with as little as $5 through apps on your phone. Apps like Robinhood, Acorns, and Stash make it easy to begin investing with very little money. These platforms often have educational resources to help you learn as you go. And the best part, you don't need a lot of money to start. Small, consistent investments can grow significantly over time thanks to the power of compound interest. Lastly, keep learning. The more you understand, the more confident you'll feel. Strategies to build your confidence in investing. Let's explore some strategies to build your confidence. 1. Educate yourself. There are countless resources available online, from articles and videos to online courses. Websites like Investopedia, Khan Academy, and Coursera offer great free courses on investing basics. 2. Start with a demo account. Many trading platforms offer demo accounts where you can practice investing with virtual money. This is a great way to learn without any risk. 3. Diversify your investments. Don't put all your eggs in one basket. Spread your investments across different asset types, industries, and geographic regions. This can help protect your portfolio from significant losses. 4. Seek professional advice. If you're still unsure, consider consulting a financial advisor. They can provide personalized advice based on your financial situation and goals. 5. Join a community. There are many online communities and forums where you can discuss investing, share tips, and learn from others. Engaging with a community can provide support and motivation. Advanced investing concepts for beginners. Now that we've covered the basics, let's touch on some more advanced concepts that can enhance your understanding. 1. Asset allocation. This is the process of spreading your investments across different asset classes, like stocks, bonds, and cash. Your asset allocation should align with your risk tolerance and investment goals. 2. Rebalancing. Over time, your investments might grow at different rates, changing your asset allocation. Rebalancing involves adjusting your portfolio to maintain your desired level of risk. 3. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. It can help reduce the impact of market volatility and remove the emotional aspect of investing. 4. Dividend investing. Some stocks pay dividends, which are regular payments to shareholders. Dividend investing focuses on building a portfolio of stocks that provide regular income in addition to potential capital gains. 5. Index funds and ETFs. These are types of mutual funds that aim to replicate the performance of a specific index, like the S&P 500. They offer diversification and are often more cost-effective than actively managed funds. Common investing mistakes to avoid. Let's also talk about some common investing mistakes and how to avoid them. 1. Trying to time the market. It's nearly impossible to predict market movements accurately. Instead of trying to buy low and sell high, focus on a long-term strategy. 2. Investing based on emotion. Fear and greed can drive poor decision-making. Stay disciplined and stick to your investment plan. 3. Overlooking fees. Investment fees can eat into your returns. Be aware of the fees associated with your investments and choose low-cost options when possible. 4. Ignoring taxes. Understand the tax implications of your investments. For example, holding investments for more than a year can qualify for lower long-term capital gains taxes. 5. Not diversifying. Putting all your money into one investment can be risky. Diversification helps spread that risk across different assets. Let's recap what we've covered. 1. Investing is for everyone, not just the experts. You don't need to be a financial wizard to start investing. With the right knowledge and tools, anyone can build a successful investment portfolio. 2. Understanding basic concepts like stocks, bonds, and mutual funds can demystify investing. These building blocks are essential for anyone looking to start their investment journey. 3. The power of compound interest means the earlier you start, the better. Time is one of your greatest allies in investing, so don't delay getting started. 4. Start small and keep learning to build your confidence. Even small investments can grow significantly over time, and continuous learning will help you make informed decisions. 5. Diversify your investments and avoid common mistakes like trying to time the market or investing based on emotions. Now that you know investing isn't as overwhelming as it seems, why not take that first step today? If you enjoyed this video, don't forget to like, share, and subscribe to the Mental Wealth channel for more tips on how to earn more and stress less. Have any questions or want to share your investing journey? Drop a comment below, we love hearing from you. Remember, your path to financial freedom starts with a single step. Whether it's learning more about investing, starting with a small amount, or reaching out to a financial advisor, every step counts. Happy investing, and I'll see you in the next video.